All right, who wants to take the next one?
I think it's my turn. I'll read it. Could you explain in simple terms the difference between and why you would recommend a DFA fund, a dimensional fund advisors fund, over something like VEQT or VGROW?
So these questions were submitted before we had our epic factor versus market cap weight
Yeah,
debate,
I feel
Dan.
like we discussed
But
this one at length for sure. So,
it was also before we did our DFA versus Vanguard episodes. We've covered this topic quite a bit since the question was asked. But I mean, as a very broad summary, I would say it boils down to two distinct reasons for why you would pick DFA over something like Vanguard. One is higher expected returns, which is a theoretical construct, and it has borne out in some cases historically, but for many recent years it has not. Dimensional tilts towards stocks with theoretically higher expected returns, which empirically, in a lot of cases, at least over the long run, have worked out, including in the live funds. And some of their funds have, well, quite a few of their funds have been able to outperform a Vanguard fund, Vanguard market cap weighted fund, but also a style benchmark. We talked about that in some detail in our DFA versus Vanguard episode. We expect, for financial planning purposes, about 40 basis points of excess return net of fees, which is not a huge number, but if it works out, it is meaningful enough, at least, that we think it's worthwhile. The other reason is multiple sources of expected return. Even if we assume that the net expected return is the same as a market cap weighted portfolio, I think having multiple sources of expected return can be kind of nice in periods like 1968 to 1982, which is a pretty long period of time where US market cap weighted real returns were about zero for the full period. Likewise, 2000 to 2010, the lost decade, where US market was flat for 10 years. In both of those cases, small cap value stocks performed quite well. So even if we assume that they're overall going to have the same return, I think the fact that you're going to get returns at different times from different sources of expected return is worth something. I think Dimensional calls it reliability, reliable long-term outcome. Japan is another one. Like 1990 to today, it's been basically flat below the returns of T-bills, which is pretty crazy. But again, Japan's small cap value and value have performed reasonably well over that period. Now, it's not a free lunch. It has not paid off for quite a while now, at least in the US market. It has in international markets. But it sucks when the market cap weighted portfolio is doing really well and small cap value isn't. That's not very fun. And you're always going to have tracking error. So there are going to be periods where you underperform and your performance is going to be different year to year. And that likewise can be just not very fun because, like it or not, people benchmark against market indexes because they're very visible. It's what's talked about in the media. And if your performance is different from that, that can be challenging. I sit on an investment committee, and I've talked to a couple other investment committees, like just as a volunteer. And I don't think that I would. This is an interesting thing to think about. I don't think that I would ever tell an investment committee to use dimensional funds, because investment committees are groups of people, typically with varying levels of financial knowledge and sophistication, who are all just working in the best interest of an organization that they care about, which is why they're on the committee. But tracking error on investment committees is, I mean, it's one of the worst things that you can have, because investment committees care about the performance relative to a benchmark. You've got these groups of people with differing levels of knowledge, and if you're underperforming the benchmark, that's just a red flag. That's bad. And so you have to have a ton of conviction to pursue a strategy like Dimensional. If you don't have that, which I think it's really hard for a committee to build, which is why I think that's an interesting example, I don't know if I would do it at all.
You know what's interesting is most of the committees I've seen, at least, and I've only sat on one, used a whole bunch of crazy active funds and alternative investments and that type of thing. Would hire and fire managers when they underperformed or when tracking error was too great. So I agree with that, man. But the funniest thing is, they often have difficulty just accepting an index fund portfolio at the same time.
I'm living through the same thing 100%. That is also a challenge. But the tracking error piece, like, it's similar to what I've seen, Mark, where it's like there's a lot of active funds, but what happens to the active funds? They get selected based on their 5-year past performance, and then they get reevaluated based on the 3-year performance. And if they underperform, they get fired, and new managers get added. It's like, this is just the institutional cycle of active manager selection and termination. But yeah, it's also, index funds are also a hard sell, which is it's a weird, I don't know what I'd call it, paradox or something.
Yeah. So, I mean, I don't know what we've talked a lot about it. I would refer the questioner back to our previous podcast, but I think it may make sense to just sort of say, as a default, as a starting point, think about the cap weighted all-in-one ETFs and only look at a factor tilt portfolio after you've put in the work to understand it. Because if you stop at the expected return is 40 basis points higher and you don't go any further,
Yeah.
you're going to be disappointed and you're not going to stick with it.
100%.
So put in the work, understand it. Once you're comfortable with the risks, then make whatever decision you want and stick with it.
And I think the other thing to consider in a lot of decisions like this, and it goes like this kind of, it's all about trade-offs, and like stuff like this comes up all the time. Like, should I invest or pay down debt? Like, just if you need to, just do both, right? And then you can just anchor to whichever one's doing better in that time period, right? Like, you're not going to get an incredible excess return out of a factor-based portfolio if half of it is in something like DFA and half is in VEQT. But the point being, you want to minimize regret at the end of the day, right? And so if you're going to buy VEQT and then factor-based portfolios do really, really well over the next 5 years, you're going to regret your decision, and vice versa, right? So oftentimes in these decisions, like with clients even, I'll just be like, well, let's just do both, right? And then you can just feel good about whatever's working in that moment.
Yep. But
Right.
I like
Move
that
on.
starting point of just using the market cap weighted asset allocation ETFs. I've said this on the podcast a couple times now. If I were a DIY investor and didn't have access to Dimensional or PWL to manage my portfolio for me, I would be using one of those asset allocation ETFs. I would not tinker with the factor tilting. I believe that it makes sense. I currently use Dimensional funds for my personal investments, and I will not change that unless for some reason I was forced to. But if I did not have access to them and I had to go and buy each individual ETF and deal with the foreign exchange and track my adjusted cost base and all that stuff, I honestly wouldn't do it. I would just buy the single ticket Vanguard or iShares ETFs.
Not
All right.
TQQQ,
What's that?
not TQQQ.
Yeah. Probably not, Mark. I can live vicariously through your son for my
Perfect.
TQQQ exposure.
Perfect. I'll keep you
You
updated.
can't have too many cues.
Yeah, well, if you can right now, he's down like, I don't know, 60% or something. He's getting absolutely lit up right now, but he doesn't care.
Right.
He doesn't care.
All
Okay,
right.
on to the next
So
one.
should we move on to the
Yeah.
next question?
Let's go.
All right. So what type of dynamic spending rules are the most used with your clients?
So I would say we don't use spending rules really at all. I think spending rules are a good way to think about doing quick math. They're also an interesting way to model different types of spending. But for real client situations, a rule is just, clients are too messy. Lives are too messy. Like reality is too messy to say we're going to apply this rule. I like modeling variable spending rules because you can see the effect of variable spending and you can show, this lets you spend more or this reduces risk or whatever. And that's interesting. You can gain insights from that. But to actually apply that to someone's situation, like if the market's down 1 year and a client was going to go on a big trip to see their grandchildren, we're not going to say, sorry, your spending rule says you can't do that this year. So tough. Like, this is not how it works. That's not how people's lives work. And that's not how people make decisions. Because if we said that, the client would be like, screw you. No, I'm doing this. Like, this is more important to me. Now, what we do is review clients' financial plans at least annually, in many cases twice a year, and make adjustments as necessary based on the financial plan. But that's going to be based on the client's situation, the client's priorities, market conditions to an extent at that time. But all those things change. So I think financial planning is just much more of an ongoing process than can be captured by any type of spending rule. So to answer the question, we don't use spending rules, but we do some form of dynamic spending that is derived from the financial planning process.
I think a lot of clients impose their own dynamic spending rules. And that's what, like in my experience, I just kind of try to harness that. So I agree with you. To me, one of the most unsatisfying financial plans for someone in retirement or close to it is you have to watch the markets, and depending on the performance this year, next year, you have to change your spending. I mean, it's just not something anybody wants to do. And it just adds to the anxiety that people are already going to feel during periods of market volatility. And it goes back to what we were saying right at the top of the show, where I was saying, if your plan is robust, you should not have to adjust your spending just because the markets fell 15% last month, right? And you don't want to, right? I like to tell people in retirement, especially, like, the possibility of a market crash is already baked into the plan. You don't have to reinvent the wheel after it happens. We don't know when it's going to happen, but we certainly expect it's going to happen a few times during your retirement, and you don't have to hit the brakes and revisit the entire plan every time it does, right? So that's the one thing. But then people will just naturally do it, I
Right.
think. And I've certainly had clients who, like, after a bad year, they'll just say, you know what, we just decided to take a more modest trip this year. I just feel a little more comfortable, and maybe we'll do it next year. And that's fine as long as it's them who are taking that initiative, and not us imposing it on them
Yeah.
and saying it's a condition of your plan. You must reduce your spending 15% this year. That is not a good outcome for anybody.
No. Next one?
Totally agree. Well said.
Oh, yeah. Go ahead.
We're at number 7, right? Yeah.
Yep.
Okay. What is the relationship between the amount to withdraw and the stock/bond allocation?
Yeah, it's an interesting question. If your withdrawal rate is low enough, you can have whatever asset allocation you want. If you're withdrawing 0.1% of your portfolio, I mean, do whatever you want. I think at more, I don't know, realistic or common withdrawal rates, there's some maybe interesting stuff in here. If you look at the Cederberg life cycle asset allocation paper that he talked about on the podcast recently, they do look for the optimal asset allocation for different spending rules. So they test 3%, 4%, which is their base case, 5% fixed spending rules. That's like 3% of the initial portfolio value adjusted for inflation thereafter, 4%, 5%. They also test 4% proportional spending, so spending 4% of the remaining portfolio value each year. So that's a variable spending approach called proportional spending. And they're using those different spending rules, and they're solving for the optimal life cycle asset allocation. And they find that it's completely insensitive to those different spending rules. It's the same all equity, 33% domestic, 67% international portfolio. Now, one of the reasons for that is because in that paper, they have international stocks, which just perform so much better in real terms than bonds. The bonds get booted out of the optimal portfolio, kind of no matter how you slice it, as Scott explained to us in the recent episode. Scott does have another paper that's actually a published paper on safe withdrawal rates specifically. So this one, they're not looking at optimal life cycle asset allocation. They're looking at safe withdrawal rates. So in that case, it's kind of confusing because they have different portfolio setups, but in this case, they're only looking at domestic stocks. So international stocks don't play into it, and they're looking at they look at in the paper different mixes of stocks and bonds, and they ask what the safe withdrawal rate is for those different asset allocations. So it's the same bootstrap methodology as you've heard Scott describe in his recent episode. But in this safe withdrawal rates paper, they're only looking at domestic stocks and bonds. Still the international sample bootstrap, but only the domestic stock perspective, not the international stock perspective. So they sort things by ruin probability. At a 10% ruin probability, they find the safe withdrawal rate is 2.2% at 100% bonds, 2.7% with 20% stocks, 80% bonds, 3.02 with 40/60, 3.15 at 60/40, 3.11. So now we've gone up to 3.15 at 60/40. We're going back down to 3.11% safe withdrawal rate at 80/20, and then down to 2.82% at 100% equity. So there is a bit of some curvature there. It's not a monotonic relationship. The trend is similar, but the safe withdrawal rates are lower if we go to the 5% failure rate. So in that domestic only sample, it does look like there is a sort of optimal mix of stocks and bonds from the perspective of maximizing the safe withdrawal rate. But again, that's constrained to domestic stocks only. If we add in stocks, it kind of seems like the 100% equity portfolio is insensitive to the amount that you actually want to spend from the portfolio.
Yeah, that's interesting. Can you expand on that a bit, Ben? So why is it that if the safe withdrawal number is 3.15% at 60/40 and it falls pretty significantly to 2.82 at 100% equity. What's the argument for being 100% equity in retirement?
In this case, if we're constrained to domestic stocks only, there's not a very good argument, because in this case, I guess the increased volatility is eating up a lot of that safe withdrawal rate. Now, if we go back and add in international stocks, because this is all domestic, if we go back in and add in international stocks, it makes 100% equity look a lot better, just because international stocks have performed quite well in real terms for long-term investors. And a lot of that is international stocks performing quite well when domestic inflation is high and domestic stocks perform poorly.
So the volatility, the 100% equity volatility is much lower at 33% domestic, 67% international, compared with 100% domestic.
I'd have to go into the papers and look at if it's that the volatility is better or that the expected real return is higher. I'm guessing that the expected real return is sufficiently higher in that case to make up for the increased volatility. But with domestic only, the trade-off is not as favorable.
And he looked at domestic regardless of where you live, right? So this isn't domestic just from like Canadian or US perspective, right?
That's correct. Yeah. So the way that they set up their paper is that it's a representative domestic investor that could be in any developed country, but they sample from a whole bunch of different countries to kind of simulate possible outcomes for a domestic investor in any one developed country. Yeah, anyway, so I don't know. I mean, that does answer the question. Scott's paper does answer it, but it's also kind of confusing because the one paper only looks at domestic stocks, and then the whole thing kind of changes when you introduce international stocks. But there could be some insight there where if we don't have, total faith that the international stocks in looking to the future are going to be as compelling of a case as they were in Scott's paper, for reasons like the correlation between international and domestic stocks has increased over time, then there could be some insight in this domestic only sample. All right, last one. This is a weird question. This is a common question, and I never really know how to answer it. I put some thoughts down, but I'm curious to hear what you guys think too.
It's not a weird question. I think it's a great question. I think the answer is a bit tricky.
I don't mean weird in the sense that it's a strange question. It's a tricky one to think through. Okay, I'll read this one. Everyone talks about HISA or alternatives for short horizon investing / saving and equities, perhaps with some bonds for long term. How do you go about optimizing for the medium term? Is it just really bond heavy, or do you take a fusion of bonds, equities, and HISA, etc.? I think the medium term is tough. I think if you have a large fixed liability, like large relative to your assets, and you're absolutely required to cover it at a specific time, I don't know what that could be for a regular retail investor, but if that's the scenario, I think covering it with a duration matched bond probably makes sense. If it's a medium-term liability that's a small percentage of your overall portfolio, you might not actually have to worry about it too much. If it's a large liability relative to your portfolio, but it's flexible in the amount and timing, again, maybe you don't have to hedge it perfectly. There's an old paper from David Blanchett talking about sort of this, why liability matching, asset liability matching doesn't make sense for households because their liabilities do tend to be flexible. You could maybe dollar cost average out of a portfolio. Like if you're going to buy a new vehicle or something like that, maybe you build up the cash position over time. Or if you're still earning income, that's if you don't have money going into the portfolio. If you're still earning income, you could think about how long you would need to save up to meet that expense and start building the position only when it's necessary, but not earlier.
Yeah, I agree. It's a tough one. And I think you laid out the options really, really well, right? Like when I talk to clients about this kind of stuff, it's like, well, are you comfortable with the chance that the money that you have invested for this particular goal could be worth 50% less by the time that goal comes? And that just goes to your point about flexibility, right? Could you move out that purchase or that obligation? Could you make it smaller than you had planned? And if the answer is absolutely not, there's this guaranteed cash outlay 7 to 10 years from now, which I can't think of a situation off the top of my head where that might be the case. But yeah, then you need something guaranteed. But most of these medium-term purchases are oftentimes like loose goals, right? Like to your point, a new car, right? And the interesting thing with something like a new car is, well, If markets are just completely in the toilet at that time, like, well, then you could finance it maybe, right? And maybe interest rates are down at that point because markets are in the toilet, and like you do have flexibility in the way you might finance that goal later on. I don't know that I have like a particular strategy that I employ regularly for a medium-term goal. I think it often comes back to client risk tolerance, client risk profile. And you end up with these bucketing strategies, right? You've got cash for the short term, like a 60-40 portfolio for the medium term, and then 100% equity portfolio for the long term. And if you take a 30,000 foot view of the portfolio, it turns out you're 80-20 overall. Like maybe that's the approach you take with the whole portfolio, and then just kind of see how flexible you can be with the goals.
Yeah, I think if there's a real world scenario that is routinely medium term that we deal with, it's RESPs. I think are a pretty good example of that. Depends. I mean, obviously, if your child is an infant, then it's much closer to long term. But, if you're looking at, how do you invest in RESP when your child is 14 or 15 years old? And well, unless it's triple leveraged NASDAQ, but I
wasn't
mean,
gonna say it.
for the rest of us,
Yeah.
if you're let's say the child's in starting high school, you're several years away from starting the withdrawals, but then the withdrawals will be taken over 4, maybe 5 years. It's hard, right, to nail down what the perfect thing is. I will say for us in practice, we're just going to err on the side of conservative, right? Like we will most likely achieve slightly lower returns than we would have if we just put it all in stocks and hope for the best. In many situations, the risky portfolio would work out well. But what we don't ever want to do is have a situation where the parent wants to take $20,000 out and we have to sell equities when they're down. I mean, it's just not very good planning, I don't think. So, you look ahead at sort of GICs, if you're going to need it in 5 years, buy a 5-year GIC. It's not really that complicated. And you can build a ladder. So you have a certain amount of cash available for each year that you expect to take the withdrawals. You can mix in some equities as well to give you the opportunity for some higher growth. And you have to understand a little bit about, to your point, Ben, about, if you're flexible. So for example, a lot of our clients are well off enough that if it's going to cost $20,000 for a year of school and we take out 15, they can make up the difference, right? They have other sources of cash. But if you're not in that position and you 100% need all of that money, I think you got to err on the side of conservative. And the other thing I would add to that is because the person asking the question, talked about being bond heavy. I mean, I think if there's a lesson that we all had driven home in the period between 2021 and 2022, bonds are a lousy short-term investment, and they're even a questionable medium-term investment. And I think we have to get specific here. I'm talking about bond funds, right? If you buy a 3-year bond, and you know what it's going to be when it matures in 3 years. If you buy a broad market bond fund these days, it has a duration of 7 or 8. If you think you're going to need that money in less than 7 or 8 years, it's the wrong product. And if you've got a time horizon that's shrinking, and I mean that in a meaningful way, like if your retirement is 30 years away, okay, it's 29 years away next year. But I'm talking about if it's 4 or 5 years away and next year, it's getting closer and closer. You cannot stay in that broad market bond fund and not expect that there could be losses over that period. So bond funds make a lousy medium-term investment, I think, unless you're going really short, right?
Yeah.
A short-term bond fund that might have a duration of 2 or 3. Okay. If you have a 4 or 5 year time frame, you can include that in there. But once that horizon gets close, you do not want to be in a bond fund because significant losses can result over the short term.
I completely agree with that. I think a point that often gets missed by investors thinking about this is that I mentioned this when I gave my answer to the question, but it's the time horizon matters. The proportion of the overall portfolio also matters, because if you're retiring in 5 years and you're spending 2% of your portfolio, you don't need to worry about declines in stocks or bonds.
Right.
If you need to spend 60% of the money that you're investing, then you really have to worry about short-term price declines. But a retiree who their time horizon before they have to start withdrawing is 0 because they're withdrawing from their portfolio now, they still have a very long time horizon. And if they're withdrawing a small portion of their portfolio annually to fund their expenses, they can still afford to take risk in both stocks and bonds. So I think that the medium term thing is like, what is the time horizon for the thing that we're talking about? How flexible is it? But also what proportion of the portfolio is it? And if it's really small, it doesn't really matter. If it's really big, I think you have to start thinking about some of the stuff that we just talked through.
This was a really good question, actually, because I think we've all kind of dealt with it, but I haven't really confronted it and thought about it as deeply as, as we've just kind of discussed. I think it's a really excellent problem to solve.
Yeah, it is.
Yeah.
And it's comes up a lot. What do you do in the medium term? So yeah, I agree. I'm glad the listener asked it.